Thanks, everybody, for taking some time out of your day to join us. I'm Ray Evans. I'm a senior partner here at InfiniTALKS Wealth Counsel, and I'm joined by Jack Evans.
Yes, I'm Jack Evans. I'm an associate wealth advisor here at InfiniTALKS Coordinated Wealth Counsel, and I also wear two hats as Ray's son. So been here a year and a half and have had a lot of fun.
He usually doesn't introduce himself that way, so that was a good first virtually. Thank you all for taking a few minutes today, and just a few moments on protocol. You're all muted currently. At the end of our presentation, there'll be a Q&A session. And Jack, if we can kind of start going to the content, we want to make sure, just as a reminder, that today we're talking about election update and the impact on investment markets over time. But as we get started, I want to do a quick little background on InfiniTALKS, just as a reminder. We are in our 8th year of being together here in Kansas City. And it's really important for us not only to talk about investment management, but also we take a very holistic approach toward financial planning with our clients. And you can see the variety of different things that we spend time on. Certainly in the last couple of years, we've spent a considerable amount of time on cash flow and forecasting where people are going to take income from in retirement, in addition to spending an awful lot of time at the other end on education planning and 529 planning. Just a reminder, November 14th, a couple of our colleagues will be putting together a really nice presentation on year-end planning. And if you'd like a free year-end checklist that we're using with clients right now, just contact Jack or myself, ray.evans@pegasuskc.com, and we'll be able to get that in your hands. One other thing to think about, we have had an awful lot of meetings this year from a next gen standpoint. And what I mean by that is we've certainly been offering to our clients a free 20-minute meeting with next generation family and friends to talk about anything they want to talk about. And that's been really helpful, I think, to engage perhaps a little bit of a younger generation that maybe is a little bit more inclined to go online first before visiting with somebody. So we'll dig into it. We're going to talk a little bit about elections and the impact on financial markets. And again, we've got, if you'd like a copy of most of this presentation, we can get that in your hands afterwards. But probably one of the biggest things we notice that is maybe a little bit of a fallacy is what happens in election years. And typically, it's normal for people to be anxious about change, particularly if you don't have an incumbent running. And so as a result, we tend to see much higher dollar amounts that go into money market funds as opposed to inflows into stock and bond portfolios. So one of the things we track is how much money is actually in money market funds. A normal number is like $3.5 trillion. And currently in money market funds in the United States, there's $6 trillion. So as one of my clients said, there's a whole lot of money warming up in the bullpen. And you'll notice here to the far right, in year 4 of an election year, actually years 3 and 4, it's very normal for money to accumulate in money market funds. But Jack will show you in just a second, and certainly this year is a typical example of that. Actually, that can be a bit of a mistake because election years are typically pretty good years in the market.
So looking at this chart, and I'll explain it going kind of right down here. On the x-axis, you have the year going from January to the end of the year, and then the 3 months after that. And then in the y-axis, you have the year-to-date return. And so the light blue line, this is actually election years going back to 1932. And the dark blue line are non-election years, again, going back to 1932. In the blue highlighted portion, this is what's underscored as the primaries before the actual election. And so you'll see if you focus on the light blue line in the election years, you actually have pretty middling returns, historically speaking, during the primary season. You can see it kind of bottoms out at a little bit -1%, -2% in election years. It's kind of the opposite in non-election years. You generally have pretty strong market returns during the primary season from January to May or June. Then this unhighlighted portion, the white portion, is the next 12 months after the primaries. And what it's trying to underscore is in both election years in the light blue line and non-election years in the dark blue line is that there's an upward trend. And at the very end, the returns pretty much converge together. So the bottom line is the primary season tends to be volatile, but markets have bounced back strongly thereafter. What's interesting about this year is we've somewhat bucked the trend of traditional election years. So you can see, historically speaking, you can expect returns of 0 to maybe negative 1%. Well, from the start of this year in 2024 to June 4th, when the primaries ended, you had S&P 500 returns of about 13.4%. So absolutely blowing the historical norm out of the water. From June 5th to yesterday, we've had S&P 500 returns of about 9.6%. So that brings up our year-to-date return of about 23%. And if you can kind of follow my mouse, we're about right here, October 15th. And so historically, if we look to the y-axis, we're in a range of a return of 4 to 5%. That would be our return expectation. Well, we're at 23% this year, so absolutely blowing the historical norms out of the water. And so, a few of the things that are probably attributing to the strong market performance is easing monetary policy. I'm sure many of you in the audience have seen that the Fed cut rates for the first time in September at 0.5%. That was largely driven by inflation coming down, unemployment going up, and that's generally a tailwind to stock and bond markets. As Ray alluded to earlier, there is lots of liquidity out in the market right now. We see a lot of investor and institutional money in short-term cash like money market funds. And so when there's opportunities in the stock market, money can move quite quickly. And the third thing that I see that probably attributes to this really strong market year is the investor optimism around artificial intelligence, which I'm sure everyone in the crowd has heard that term by now. And so a few takeaways from the bottom line. This is an especially strong market for an election year. And the second thing would probably be to know that this is not the historical norm.
Thank you, Jack. So a couple takeaways so far. This has been a great year and a half, really, in the markets. People have a perception that there's been all kinds of volatility. Boy, it's been crazy. And we actually haven't. It's actually been a very steady ascent for about 20 months now. And that has happened with still a whole bunch of money. Again, $6 trillion versus what's normal, $3.5 trillion sitting in money market funds. So there's a whole lot of reason, I think, to be a little bit more excited. Jack talked about interest rates going down. When your money market fund only pays 4% instead of 5%, perhaps you start looking at risk assets, stocks and real estate, that can give you that kind of income and yet give you some upside as well. I'm going to take just a second real quick. A question we get from clients all the time. We have Republican clients, we have Democratic clients, and we have some in the middle. The perception is that my party is better for stocks and better for the White House. What has actually been the case is almost identical rates of return based on whether a Democratic or Republican White House existed. It's just slightly higher, like 0.2% a year higher with a Democratic White House, but it's not an appreciable difference. And I think you can see this going all the way back to FDR in 1933. Whether you're blue or red in the White House, you have had a steady ascent and an increase in valuations. And if you average all that, even including all the negative years, that's approximately 11% per year. So stocks, again, takeaway here, stocks have ascended no matter who's in the White House. Certainly there are industries that benefit from one or the other. In all likelihood, if Trump wins, for example, that probably helps the energy industry. If Harris wins, that probably helps alternative energy and some other different industries. So some of those kind of subtle changes happen. But as Jack said the other day, we were talking about this, and he goes, it's not like I'm going to use less dishwashing liquid or I'm going to turn my computer on less, depending on who's in the White House. So really interesting how through the years, while there may be fundamental differences regarding different policies, the returns are very, very close to being the same.
Absolutely. So this next slide is really an extension of what Ray just talked about, and I'm going to maximize this a little bit, somewhat small. But what you're looking at here is the presidential administration. You've got the return on the y-axis, and then you'll see 4 bars under each administration or column. So the dark one on the left is the first year, second year, third, and fourth, and so on. And so instead of digging down into each administration and talking about each individual year's returns, I'm going to go straight to the bottom line here. And this goes back to 1929, so 92 years ago. In 67 of the 92 years, so 73% of time, the S&P 500 has provided positive performance. So this is just a great reminder that no matter what's going on in the world, geopolitically, economically, stay invested. The odds are in your favor. The average total return over a 4-year term, so from start to finish, is 46.18%. And when a Republican's in office, the average yearly total return is 7.85%. And a Democrat at 14.93. Those are both very strong equity market returns. And so the odds are in your favor. You know, there's always going to be something on the headlines that will sway you to put cash in money market funds, to stay safe, to be scared. But if we remember the long-term averages, use history as our guide, it pays to stay invested in the equity markets.
You know, one thing Jack mentioned, I'll let you go to the next slide. Thank you. Good market data goes back essentially to about 1929 or so. And if you actually look at all those years, you're positive on a calendar year standpoint, 72 out of 98 years, 73% of the time. So obviously do the quick math on that. 3 out of 4 years are positive. And so obviously the odds are in your favor. And that's why market timing is so difficult to do, because the odds are in your favor that the market's going to go up. The second thing that you maybe, and that I think is not on here, that's a little confounding, is if you do that on a daily basis, only 53% of the days are positive. So sometimes I'll show this chart in an early conversation with somebody talking about how markets do over long periods of time, and they'll say, "Oh, there's no way it's positive 3/4 of the time." Well, it actually is on a calendar year basis, only 53% on a daily basis, and I think sometimes that skews this. One last thing on this. This is 98 years of data. You can see the number of times the market's been up: 0 to 10%, 14 times, 10 to 20%, 21 times. But of all of the situations, 37 out of 98 times the market's up over 20%. So it's hard to gauge risk. And certainly I think everyone has a bit of a change in risk tolerance over a period of time. But it is interesting this year being kind of fitting into that far right column, at least so far. What happens more than any other occurrence is a return over 20%. We're not telling you that's going to happen, but it is nice to see that be the bigger number.
So this next slide we're going to go into is about stock market concentration. And I think it's important, before I explain the chart itself, to talk about what the S&P 500 is. And so the S&P 500 is composed of the 500 largest stocks in the U.S. stock market. So when people say the word the market, they're really referring to the S&P 500. And it's important to understand the weighting within that as well. The S&P 500 is what's considered a market capitalized weighted index. So pretty simply, the largest companies have the largest representation and weighting and proportion within the index. And so what you're looking at here on the x-axis is the year. On the y-axis is the next 12 months price to earnings ratio. And the price to earnings ratio is a very well accepted valuation measure. It's price of the stock's current price over its projected earnings per share over the next 12 months. So if you're looking at this chart, the teal line here is the 10 largest S&P 500 stocks. And it's very likely that you've heard of almost all of them. They're names like Apple, Meta, which was formerly Facebook, Amazon. And the gray line is the other 490 names in the S&P 500. So the way to think about this stock is, if you are up high, these stocks are considered expensive. If they're down low, they're considered historically cheap. And so one thing that you'll notice when we move to the far right part of the graph is that the top 10 stocks in the S&P 500 are much more expensive than the other 490 names. And one thing I want to remind people is that the companies that compose the 10 largest of the S&P 500 stocks are really good companies. Apple, Amazon, Facebook, Google, Netflix, those types of things. Very, very competitive companies that have long competitive advantages. But kind of the analogy that I like to use is think of your favorite steakhouse. And historically, you could get your favorite cut of steak for 50 or 60 bucks. And you go back 2 years later and the steak's the same. It might be even better. It's more well spiced. The meat's a little bit more tender, but now it's 80 or 90 bucks. You start to think in your head, man, is my favorite cut of steak still worth it? And so that's kind of where we're at today. So it's not to say that these companies aren't going to be around for a long time and continue to be successful, but we feel like there are better deals, there are better options on the menu out there.
I like the menu and steak analogy. Hey, can you back up a little bit to the peak CD rates slide? Thank you. So this is interesting too. We're going to pivot a little bit from stocks and talk a little bit about bonds and CDs. So certainly as interest rates have trekked up over the last couple of years, the great thing is it's a bummer if you're borrowing money. It's a bummer if you're getting a mortgage. But if you're a saver and you bought a CD or a treasury bill or something like that, you've gotten some terrific rates of return. Well, Fed started lowering interest rates, as we talked about. And so this is really some good data talking about the time that CDs hit their peak rate and what happened to different bond categories over the next year. So again, take a second on this. What this shows you is the 12-month return for short-term bonds, municipal bonds, what we call core bonds, which are high quality, both governments and corporates, and then just corporate investment grade corporate bonds. And again, a reminder, it's kind of a dumb example. When interest rates go down, the value of a bond goes up and vice versa. When interest rates go up, the value of a bond goes down. Well, interest rates are going down and it looks like they're going to go down for at least several months and maybe go down in a couple of different tranches. If you could go to that far right column, because we're seeing the same thing right now, and look at the performance, the return, total return, not just interest, but the increase in price of investment grade corporate bonds following interest rate declines, the peak in CDs. And certainly it's a significant return. And if you look at the average return of all of those bond categories, when interest rates are declining from peak rates, and essentially you're looking at double-digit returns. So we're not saying that's going to happen, but that's typically what happens with fixed income, with bonds. When interest rates decline, the value of the bond goes up and becomes obviously a bigger component of your portfolio. Excuse me. So that is a good thing on the bond side. And certainly we're happy about that because we had a couple of years in a row where we were showing people negative returns on bonds because interest rates were going up so fast. So we're going to pause here for a second. Again, we are less than we're about 30 days-ish from an election. And it looks like it's predictably neck and neck. And it could probably come down to the same few key states. Know that prior to the election, due to a little investor anxiety, and this has happened almost every year we've been doing this, you'll have some volatility in the markets, both up and down. And then once the election's over, once a little bit of uncertainty is removed and you get a better idea of policy moving forward, things typically tend to level out a bit and there's some stability that returns. So with that, I'll ask Kimberly, our moderator, and Diane to unmute folks, and we're happy to take any questions.
All right, at this point, you have the option to unmute, or you can also use the raised hand feature at the top of your screen to let us know if you have a question.
I have a quick question.
Yes,
Absolutely.
Okay. Are the slides that you just showed, are they going to be available after the webinar?
I believe, Kimberly, are those compliance approved? I believe they are. And if they're not, we'll submit them and make sure that we find out what we can send you.
Okay, very much.
Yes, they are compliance approved and we can absolutely send them to you. Feel free to email us at info@infinitalkskc.com
Okay,
and I can get that over to you.
thank you.
This is Steve Paddock. You guys have given me confidence that, election year timing is a bit of a myth, that you want to kind of hold on with both hands and stay the course and bounce over to the other side. But you did, Ray, talk about the distinction maybe between administrations as it pertains to policy and how policy might impact certain industries or individual companies. Can you guys maybe downshift a little and elaborate on that dichotomy with this particular election?
Yeah, thanks. Good question. I mean, I think that's, and these are certainly more opinions than anything you should take to the bank. Steve, one of the things I think is curious is where energy prices are. And there is obviously great incentive for alternative sources of energy, whether it's lithium or solar or whatever it might be. And several of those categories have certainly bounced up in this administration. And there's an emphasis with this administration on those categories. So I am curious, at a time when Israel and Hamas are duking it out, and we are much more energy independent than we used to be. But it does seem to me like energy prices are relatively inexpensive long-term, conventional energy, oil and natural gas. And I would guess if Trump won, that would be a category that would bounce. If Harris wins, my sense is that might be a bit of a deterrent on stock prices of financial institutions. Typically, that would imply a little bit more regulation and a little bit more expense in that category. Jack, I don't mean to speak for you, but any thoughts you've got?
The thing I'm watching closely is the proposal on the tax for unrealized capital gains. That really only applies to ultra high net worth individuals, but I also think that could change their investor behavior. And a lot of these folks are majority shareholders in companies like Tesla or things like that. So I think that that's something to keep an eye on. And that's something that we're watching for.
And Steve, we're also I shouldn't say looking forward, but we're anxious to see what happens with the so-called sunset of the 2017 tax law changes. And, really nobody knows yet. I mean, some people are trying to make some guesstimations about activities they might take in anticipation of tax brackets going up or down in certain categories, but we really don't know yet.
Okay. And in the case of a change to tax policy, it really just calls for a change in strategy, I guess. I mean, it's not as if you would have to make wholesale changes. You would just maybe alter your portfolio mix to take advantage of either the increased or decreased tax effect.
Correct. Although we have some clients that are considering selling some assets that they may not have considered selling because they think they'll be taxed at a higher bracket moving forward. And we certainly we don't know that. I wouldn't bring that to anybody's attention, but I think you try to dig in deep into some of that, and it can make you a little bit nuts, but we just don't really have enough information on that. So clearly that's going to be something that's going to be heavily scrutinized, whoever wins late this year and early next year.
Thanks.
Thank you. One thing I might bring up, the one thing we really don't care market-wise who wins and who doesn't. But I will say, I think gridlock is good. And I think one branch being, at least one of the three branches being in the other party, is a good thing. And so I know from an investment perspective, I'm certainly rooting that there's not a blue or red wave all the way through. Both parties are guilty of too much spending, and probably the biggest issue for me, we got 35 trillion in government debt now. It was 11 trillion 12 years ago, so we've tripled in 12 years and change. And so I don't know that either party's really serious about cutting it. And so I would sure love it if somebody would be somewhat aggressive in that standpoint from that standpoint and really get serious about cutting spending. And if you do have one party in charge of all three branches, that probably is not likely to happen. So to me, gridlock's okay on Capitol Hill.
Do you think it's better to, what I'm hearing, going to a corporate bond during this uncertainty time, better to lean heavily on that, or bonds at that time since interest rate is climbing down? Is that what you think is the right investment for that uncertain time?
It's a good question. If we use history as our guide, it's definitely a strong returning asset class given the current environment. But what I would say is to consult your financial advisor based on your current financial goals, asset allocation mix. These things all depend on what you want to achieve over the short, intermediate, and long term. And so that would be my advice on that front.
It's a great question because as interest rates go down, it's easier to think conservative. I mean, it's a great question because as interest rates go down, bonds go up in value. You get a total return that's, as we've seen, historically pretty good. So again, to Jack's point, kind of depends on your risk tolerance and your timeline and when you're going to need that money, those kinds of things. Any other questions? Well, a couple of things. One, thank you very much for taking the time today. Really, really appreciate it. Hope this was helpful. If you'd like a copy of this compliance approved slideshow, we can certainly get that in your hands. Just email us info@infinitalkskc.com and we'll get that in your hands. Also, I would draw attention to the year-end financial checklist. Really, really helpful tool. Happy to get that in your hands at the same email address. Couple of events, November 14th. Again, two of my colleagues, David Pacer and Blake Workman, are presenting on year-end planning, and that'll be a good session. And then from the fund standpoint, you'll all be invited December 21st. We've done this several years in a row. It's a Saturday. And you're welcome to be our guest and bring family and various folks to, we've got Prairie Fire Theaters sequestered that morning, and we have about 4 theaters, and we are having Lion King, not the animated Lion King, but the new semi-real people Lion King. So anyway, with that, thank you all very much. We sure appreciate you guys tuning in and hope this was helpful. And we look forward to seeing you soon. Take care.
Thanks, everybody.
Thank you.
Thank you.